Classical Accountancy Numerical Problem Solutions, presented by eduxi.com. In this video, we are going to provide Accounting for Partnership Basic Concepts, Past Adjustments Solutions, Problem 40 Solution. The problem statement is as follows. On March 31st, 2000 XA, the balance in the capital accounts of Eluin, Monu, and Ahmed, after making adjustments for profits, drawings, etc., were 80,000 rupees, 60,000 rupees, and 40,000 rupees, respectively. Subsequently, it was discovered that interest on capital and interest on drawings had been omitted. The partners were entitled to interest on capital at the rate of 5% per annum. The drawings during the year were Eluin 20,000 rupees, Monu 15,000 rupees, and Ahmed 9,000 rupees. Interest on drawings chargeable to partners were Eluin 500 rupees, Monu 360 rupees, and Ahmed 200 rupees. The net profit during the year amounted to 1,20,000 rupees. The profit sharing ratio was 3:2:1. Record necessary adjustment entry. So, as per the problem, we have to give the adjustment entry. As you know, we can record the adjustment entries in two methods. In the first method, we do this through the profit and loss adjustment account. In the second method, we do this directly in the partner's capital account. By the way, as nothing is specified in this problem, we assume that we are going to use the fluctuating capital method. Now, it is given in the problem that the interest on capital was omitted. Also, the interest on drawings is also omitted. So, if we follow the first method, we need to make multiple entries in the journal. Now, as it is explicitly asked in the problem to give the adjustment entry, indirectly it means that we need to use the method which requires only one single entry. I repeat, this is another way of saying that we should use the method that makes the adjustment through only one entry. This is nothing but the second method, wherein we record all adjustments in the statement showing the net effect of past adjustments, and finally we record only one journal entry in the journal. Now, it is specified in the problem that there are few entries omitted. The first entry that was omitted is that of interest on capital. So, let us first calculate the interest on capital in the working notes. Now, to calculate the interest on capital, we use the formula interest on capital is equal to the opening capital multiplied with the interest rate upon 100. So, if we know the opening capital, we can calculate the interest on capital. Now, it is given in the problem that the capitals of the partners are 80,000 rupees, 60,000 rupees, and 40,000 rupees. It is also given that these capital amounts are the balances in the capital accounts of these partners. In other words, these are the closing capitals of the partners. These are not opening capitals, but no worries. We can still find the opening capital, and from that we can calculate the interest on capital. Now, if we know the opening capital, see, here we don't know the opening capital. But in case if we know the opening capital, and to that if we add the interest on capital and lessen the drawings and lessen the interest on drawings, add the profit share, it would give us the closing capital. But in the problem it is given to us that the interest on capital as well as the interest on drawings were not considered and were omitted. So here, let us not consider the addition of the interest on capital. Let us also not consider the lessening of the interest on drawings. What we need to consider is the lessening of the drawings and addition of the profit share. Now, our aim is not to calculate the closing capital. To find the interest on capital, we should know the opening capital. So, let us keep the opening capital on the left hand side and let us send these drawings to the right. Let us also send this profit share to the right. So, this becomes opening capital is equal to closing capital, add drawings, and lessen profit share. See, we are lessening the drawings on the left hand side. So, if we send the drawings to the right, we should add the drawings. Similarly, we are adding the profit share on the left hand side. So if we send the profit share to the right, we should lessen it. So to calculate the opening capital, we need to know the closing capital, the drawings, and the profit share of each partner. Now it is given in the problem that the closing capitals of the partners are 80,000 rupees, 60,000 rupees, and 40,000 rupees respectively. It is also given that their drawings are 20,000 rupees, 15,000 rupees, and 9,000 rupees. These two things are directly given to us. But the profit share is not directly given to us. But instead, it is given that the net profit during the year is amounted to 1,20,000 rupees. From this, we have to find the profit share. Now, to calculate the profit share of each partner, we need to find the net profit that should be distributed among the partners. See, the net profit is not directly distributed to the partners, right? From the net profit, we have to allocate the appropriations and then the remaining profit should be distributed among the partners. So, the distributable profit can be calculated by considering the net profit, and then from that, we lessen the interest on capital and add the interest on drawings. Now, it is given in the problem that the interest on capital was not considered or omitted. The interest on drawings was also not considered or omitted. So, the net profit is distributed among the partners without considering the interest on capital and interest on drawings. In other words, all the net profit is distributed among the partners. Now, it is given in the problem that the profit sharing ratio of the partners is 3:2:1. Considering this, the profit share of the partner Eluin will be equal to the total net profit amount of 1,20,000 rupees multiplied with his profit sharing ratio 3/6. Cancelling with 6, 6 ones are 6 20,000 are. Now, if we multiply the remaining 20,000 rupees and 3, we get 60,000 rupees. This is the profit share of the partner Eluin. Now, the profit share of the partner Monu will be equal to the total net profit amount of 1,20,000 rupees multiplied with his profit sharing ratio 2/6. Cancelling with 6, 6 ones are 6 20,000 are. Now, if you multiply the remaining 20,000 rupees and 2, we get 40,000 rupees. This is the profit share of the partner Monu. Now, the profit share of the partner Ahmed will be equal to the total net profit amount of 1,20,000 rupees multiplied with his profit sharing ratio 1/6. Cancelling with 6, 6 ones are 6 20,000 are. The resulting value of this calculation is 20,000 rupees. This is the profit share of the partner Ahmed. So now we have everything to find the opening capital as well as the interest on capital. Let us first write the heading Calculation of Interest on Capital. In a table, let us have a column for amount in rupees for partner Eluin, one column for amount in rupees for partner Monu, and one last column for amount in rupees for partner Ahmed. Let us first write the closing capital of each partner. Just to remind you, the closing capital of each partner is given as 80,000 rupees, 60,000 rupees, and 40,000 rupees. Let's write this in our table. 80,000 rupees, 60,000 rupees, 40,000 rupees. To this, let us add the drawings made by each partner. Just to remind you, the drawings made by each partner are given as 20,000 rupees, 15,000 rupees, and 9,000 rupees. Let's write this in our table. 20,000 rupees, 15,000 rupees, and 9,000 rupees. Now, as per the formula, we have to lessen the profit share. And as we have just now calculated that the profit share of the partner Eluin is 60,000 rupees. The profit share of the partner Monu is 40,000 rupees. And the profit share of the partner Ahmed is 20,000 rupees. So, let's write less profit share. Let us write the profit shares of the individual partners as 60,000 rupees, 40,000 rupees, and 20,000 rupees. Now we have everything to calculate the opening capital. For partner Eluin, from the sum of 80,000 rupees and 20,000 rupees, if we subtract 60,000 rupees, we get 40,000 rupees. For partner Monu, from the sum of 60,000 rupees and 15,000 rupees, if we subtract 40,000 rupees, we get 35,000 rupees. For partner Ahmed, from the sum of 40,000 rupees and 9,000 rupees, if we subtract 20,000 rupees, we get 29,000 rupees. Now, as we know the opening capital, we can now calculate the interest on capital. Just to remind you, the formula for calculating the interest on capital is given as interest on capital is equal to opening capital multiplied with the interest rate on capital upon 100. Also, the interest on capital is at the rate of 5% per annum. So, with this information, let's calculate the interest on capital. Now, the interest on capital for the partner Eluin is his opening capital amount of 40,000 rupees multiplied with the rate of interest on capital, which is 5 upon 100. Let us cancel both the zeros in 100 for 2 zeros in 40,000 rupees. Now, if we multiply the remaining 400 and 5, we get 2,000 rupees. This is the interest on the partner Eluin's capital. Now, the interest on capital for the partner Monu is his opening capital amount of 35,000 rupees multiplied with the rate of interest on capital, which is 5 upon 100. Let's cancel both the zeros in 100 for the 2 zeros in 35,000 rupees. Now, if we multiply the remaining 350 rupees and 5, we get 1,750 rupees. This is the interest on the partner Monu's capital. Now, the interest on capital for the partner Ahmed is his opening capital amount of 29,000 rupees multiplied with the rate of interest on capital, which is 5 upon 100. Let's cancel both the zeros in 100 for the 2 zeros in 29,000 rupees. Now, if we multiply the remaining 290 rupees and 5, we get 1,450 rupees. This is the interest on the partner Ahmed's capital. Wait, why did we do all these things? We did this because the interest on capital was omitted. So, we are preparing the adjustment entry to post the adjustment directly in the partner's capital account. Now, as this is interest on capital, we should post this on the credit side of the partner's capital account. So, let us record this in the statement showing net effect of considering past adjustments. Let us have the columns for details, amount in rupees for partner Eluin, amount in rupees for partner Monu, amount in rupees for partner Ahmed, and finally total amount in rupees. In the details column, let us first write amount which should have been credited by way of interest on capital. This is the amount which was supposed to be credited but not credited. For partner Eluin, this is 2,000 rupees credit. For partner Monu, this is 1,750 rupees credit. And for partner Ahmed, this is 1,450 rupees credit. Now the total of these three credits is 5,200 rupees credit. With that, we have completed considering the interest on capital which was not credited earlier. Now, as specified in the problem, the next item that was omitted is interest on drawings. And we don't have to calculate the interest on drawings. It is directly given to us in the problem as for partner Eluin it is 500 rupees, for partner Monu it is 360 rupees, and for partner Ahmed it is 200 rupees. Now, to reconsider the previously omitted interest on drawings, we should debit the partner's capital account for each partner individually. So, in the details column of statement showing net effect of considering past adjustments, let's write amount which should have been debited by way of interest on drawings. For partner Eluin, this is 500 rupees debit. For partner Monu, this is 360 rupees debit. And for partner Ahmed, this is 200 rupees debit. And the total is 1,060 rupees debit. With that, we have completed the consideration of the entries that were omitted. Now let's find the result of these amounts. Now for partner Eluin, from 2,000 rupees credit, if we subtract 500 rupees debit, we get 1,500 rupees credit. For partner Monu, from 1,750 rupees credit, if we subtract 360 rupees debit, we get 1,390 rupees credit. For partner Ahmed, from 1,450 rupees credit, if we subtract 200 rupees debit, we get 1,250 rupees credit. Now the total of these subtotals is 4,140 rupees credit. See, there is one thing that we should understand here. There is no change in the total net profit. The only change is the form in which it should go into the partner's capital account. These 4,140 rupees should have gone into the partner's capital account in the form of interest on capital and interest on drawings. But it is deposited or credited into the partner's capital accounts as distributable profit according to their profit sharing ratio. See, we have wrongly deposited or credited the partner's capital accounts. To correct this, we should debit the partner's capital accounts. Now, you might have a question that why should we debit? See, there is an overcredit of the profit share amount in the partner's capital account. To reverse this effect, we should debit the partner's capital account. Now, as you know, these 4,140 rupees were wrongly distributed to the partners in their profit sharing ratio. So, let's find out how this amount was credited to the partner's capital account in the form of profit share. Now, it is given in the problem that the partners are sharing profits or losses in the ratio of 3:2:1. So, using this ratio, let's find out how these 4,140 rupees were distributed to the partners as profit share. Let's first write the heading loss sharing as per the loss sharing ratio. See, here it's not actually a loss. It is decrease in the profit share to correct the overcredited profit share. You should understand it this way. Now, for partner Eluin, this is equal to the total overcredited net profit, which is 4,140 rupees multiplied with his profit or loss sharing ratio 3/6. Cancelling with 6, 6 ones are 6, 690s are. Now, if you multiply the remaining 690 rupees and 3, we get 2070 rupees. This is the amount of profit share that should be debited from partner Eluin's capital account to reverse the overcredited profit share. Now, for partner Monu, this is equal to the total overcredited net profit, which is 4,140 rupees multiplied with his profit or loss sharing ratio 2/6. Cancelling with 6, 6 ones are 6, 690s are. Now, if we multiply the remaining 690 rupees and 2, we get 1,380 rupees. This is the amount of profit share that should be debited from partner Monu's capital account to reverse the overcredited profit share. Now, for partner Ahmed, this is equal to the total overcredited net profit, which is 4,140 rupees multiplied with his profit or loss sharing ratio 1/6. Cancelling with 6, 6 ones are 6, 690s are. The result of this calculation is 690 rupees. This is the amount of profit share that should be debited from partner Ahmed's capital to reverse the overcredited profit share. To correct this, we should debit the partner's capital account with these amounts. So, let's write the description of this entry as the amount that should have been debited by way of profit. This is 4,140 rupees divided in the ratio 3:2:1. See, we usually don't debit the profit. We credit the profit. But here we wrote that this is the profit share that should have been debited. This indirectly means that we are reversing the overcredited amount. I repeat, indirectly this means that this much amount should not have been credited. Here we are considering the not crediting as debiting. In other words, we are reversing the effect of overcrediting by debiting. That said, partner Eluin's capital account should be debited with 2,070 rupees. Partner Monu's capital account should be debited with 1,380 rupees. Partner Ahmed's capital account should be debited with 690 rupees. Now the total of these debits is 4,140 rupees debit. And now finally, the required adjustment that should be made is calculated. This is the difference between the item 3 and 4 above. Now for partner Eluin, the difference between 1,500 rupees credit and 2,070 rupees debit is 570 rupees debit. See, this amount is debited because overall this much amount of excess was credited earlier to this partner's capital account for partner Eluin. Now for partner Monu, the difference between 1,390 rupees credit and 1,380 rupees debit is 10 rupees credit. See, this amount is credited because overall this much amount was shortage and was not credited earlier to this partner's capital account for partner Monu. Now for partner Ahmed, the difference between 1,250 rupees credit and 690 rupees debit is 560 rupees credit. See, this amount is created because overall this much amount was shortage and was not created earlier to this partner's capital account for partner Ahmed. Now, after preparing this table, these final required adjustment entries will go into the journal. So, let's first prepare the journal format. Let's first write the partner Eluin's capital account as the debit entry. Let us also write the text DR to indicate that this is a debit entry. Let's then write the debit amount of 570 rupees in the debit amount column. Leaving a margin, let's write partner Monu's capital account as the credit entry. Let's then write the credit amount of 10 rupees in the credit amount column. Leaving a margin again, let's write partner Ahmed's capital account as the other credit entry. Let's then write the credit amount of 560 rupees in the credit amount column. Let's then write the description or narration of this transaction as being adjustment to the profit for omission of interest on capital and interest on drawings. If you notice here, we recorded all the entries in partner's capital account. No other account is touched. So with that, we have completed the recording of the adjustment entry with the second method to record the adjustments directly in the partner's capital account. And with that, we have come to the end of the solution to this problem. Thanks for watching. Edixit.com is started to promote effective and efficient learning process to help the students with their learning requirements. To watch all our videos, please subscribe to our channel. Also, please click on the bell icon to receive a notification as soon as a new video is published. Please click on the like button if you like this video. Thanks for watching.